I would now like to turn it over to James Nicholson, President and CEO of North Valley Bank in Zanesville, Ohio. James, the phone is yours.
Thank you, Krista. And I just want to thank you for having me on the panel and the opportunity to share at least one bank's experience or perspective on the topics presented here. And certainly congratulations to the authors on having your papers selected for the conference. But just to start out, would be helpful to have an overview of North Valley Bank. Just to put things in perspective, we're our total assets, I'll say before the pandemic, or at the end of 19, were $230 million. But I would also add, we just had acquired 2 banking offices, deposits only, that December. So realistically, kind of headed into it, we had historically been about a $200 million in asset institution. And the deposit acquisition came into play a little bit as we headed into the pandemic. Currently, at June 30th of this year, we're at $314 million in assets. Admittedly, it's inflated probably by about $20 million as we utilize the PPPLF borrowing program to fund some of our PPP loans. We have 7 banking offices really in rural communities, and I would also note 7 banking offices, but we're in 6 counties, so we're pretty geographically spread in southeastern Ohio, and quite frankly, in not high growth markets. So economic growth is very, very stagnant. We're a state chartered Fed member, 78 employees. I would say that a little unusual that, for our size, very much a business banking focus, commercial lending and relationship focus. We believe our core competency is really around business and commercial lending. We have a very talented and experienced group of bankers and leaders in that area. So our value proposition is built around, local service, being a partner, and having access. I think, when you look at where do we play in that space, I think when you compete against the regional banks in this, and I'll call it their small business space, pretty much theirs has to fit in a box. It's cookie cutter straight, very clear. If it's in the box, they do. If not, they don't. And we tend to probably play more towards the edges of the box, and where I think, as the paper indicated, you have soft info, where we either have relationships, they're your neighbor, it's local, you have a greater sense of what the business or project might be about. So we tend to probably play closer to the edges where the soft info is valued. I need help on directing the next slide. And I might add, we do have a SBA specialty lending niche, so very unusual for our institution our size. And the banks that I've been involved with in the past, for the last pretty close to 30 years, we've always had an SBA specialty lending group dedicated. So it's a dedicated group for SBA lending. We typically cover the whole gamut within our footprint as far as types of businesses and projects, but we do lend outside of our footprint with specialty lending, primarily business acquisition in very selected and targeted industries, but doing it on a very, very large geographic basis. Wanted to quickly give you our activity on the PPP side, outsized participation relative to our size. We broke it down and looked at it both in time frames, but also we categorized everyone as, were you a current customer? Are you a prospect, which means you're in our footprint, but you're currently banking with someone else? And then we have what we call our transaction opportunities, where we've partnered with another lending institution that was not going to participate in PPP. We were a partner with them, not a threat to go after their customers. So that was kind of the third piece of it. So in round one, when the first funding ran out, we had 246 loans approved through the SBA. You can see average loan size a little larger, median loan size much smaller. Although when you looked at the transaction group, those were larger type loans. Round two, you can see everything came down a little bit. But I might add, in round one, we were able to execute for all of our customers that either we had reached out to or had contacted us. We got everything processed, and being an active SBA 7A lender, we were already set up with E-Tran, so we hit the ground running the minute the program opened. One thing I will note, we did do 2 loans that were over $2 million. They were deposit customers, but we did not have any lending relationship. Their primary lending relationship was with a regional bank. As you can imagine, given the size, it was a larger business whose needs were really being met with a regional bank. But I think early on, we had early success. If we can move on to the next slide, I'll continue on here. But and became kind of got branded or had the reputation of being experts in this program and with SBA. As you can see, then when round 3 came out in 2021, we were thinking, no idea how many would be eligible because there are some new program parameters. Of our first draws would be eligible for a second draw. And we were really kind of surprised at the level of first draw volume because we stayed active lending in the PPP program until the end of round 1 in August, right up until the very end, where a lot of other players kind of shut it down and wanted to move on to other things. I think the difference in this 2021 was the Schedule C, small businesses, basically sole proprietor. There was some clarification of issues and they became eligible. Thus, we had a high volume of first draw borrowers in the PPP program. I think as you can see, this round, much lower, both loan size, average and mean and median. But I think we were very surprised in the volume. We thought we would do maybe a quarter of what we did the first round, and we ended up actually doing more loans in the second round. So at the bottom, you can see a quick summary of our activity. More dollars funded in the first round, but more loans in the second round. I think if we can move on to the next slide, PPP turned out to be a huge win for us as a community bank, and I think community banking overall. We couldn't have purchased better advertising and branding and marketing for community banks in this process. I think because the value of a relationship, having access to your banker, and the fact that small businesses have a higher importance to small banks, all came to light during the early days of PPP. Because I think community banks were able to deliver when it counted the most, and all of a sudden that value is recognized again. So I think industry-wise, as technology evolves and conveniences, and pricing gets more competitive, you're always competing against that technology and the large regional banks who have tremendous resources to provide those conveniences. Our initial considerations were we had 3 resources we had to allocate: liquidity, capital, operational capacity. Liquidity, we were in pretty good shape initially because we had just purchased those deposits. So that was great from a PPP standpoint, not so great from overnight rates, where we thought we could earn on those until we got them deployed, basically went to zero almost overnight. Capital, we have limitations with our capital ratios, and that was going to be our main constraint on how much we could grow our balance sheet. And then operational capacity, having the resources to underwrite and process those loans. So our initial prioritization were existing loan and deposit customers, because our concern, obviously, with our loan portfolio was small businesses may have a tough time, don't have a lot of staying power to get through a shutdown. So we wanted to prioritize those, particularly those that might be in some of the industries hit hardest, such as hospitality, food, restaurant, etc. The other thing that came to light was just the ease of underwriting and documentation. I do think, the larger the small business, the cleaner and more concise the information was that would be available to do the underwriting. I think the challenge, though, as you get larger, or that the ownership structure and eligibility for the program could get murky when there's a lot of different tiers and subsidiaries and who are the primary principals and owners. So that was probably our most difficult process, was trying to be very clear as to eligibility and making sure that it met the criteria. We also then wanted to prioritize in-market prospects and referrals. We really tried to limit how much we would do with partner banks, and we limited loans that were larger in nature, just because we didn't want to run out of capacity. Our other considerations, we were concerned about the program running out of funding, so we had all hands on deck trying to get through and make sure our clients and prospects could get their loans processed. And then I think we all had, okay, that's great to get it through, but what about the back end? How difficult and onerous is the forgiveness process going to be? So those were all things that we were thinking about. I think the program evolved over time, so our prioritization and resource allocation also evolved over time. The LF program changed the game for us because all of a sudden we had funding and we didn't have to worry about capital ratios. We embraced the program early, had that success, and it resulted in significant, when you look at those prospects, most of those are coming from regional and larger banks because they got lost in the system. It was all, they didn't have access to people. It was, they submit online, they didn't hear anything for 10 days. They don't know if it's been received and it's being processed. So that was the huge win for us, is that all of a sudden the value of knowing and having those relationships. I think, the other thing that gave people confidence as the program moved along and it was changing daily, I think most of the changes occurred that would be to the benefit of the program borrowers, that this was something to be helpful. But at the same point in time, there was hesitancy because didn't want government looking into there and being involved in the business. Always concerned election year would create a political football that would try to be exploited. But I think as it went through, everybody got comfortable. I think continuing on, and I apologize, I'm out of time, but well-intended regulation legislation, I think it always has unintended consequences. As a small bank with limited resources, we typically really value the fact that there is a stratification and size consideration when new legislation comes into play, and that it's not a one-size-fits-all because you got such diversity in the organizations. But we're always aware of thresholds and what it might mean. I think relative to our size, really strong correlation between size when you're this small and overall performance, return on assets, and efficiency ratios, which could be the drivers. So as you can see, we kind of have grown and feel like we need to get to a threshold of like 500 million because that seems to be the optimal space for community banks as far as performance goes. And so I'm out of time, but appreciate everything and turn it back over.